Hey everybody, Lawrence here from financialthing.com. Today is April 23rd on a Thursday. Welcome. Hope everyone can hear me while we're in the office today because last week's stream, the laptop decided to drop the Wi-Fi, so I figured I would go for a more wired-in version of the stream, so hopefully that will not happen. So welcome, yes, lots to talk about this week. Investing. We're going to talk about FSCS protection on your account, some things that you may want to check on during this COVID time of uncertainty with the financial institutions. I think nobody is immune to that, so we're going to talk about FSCS protection, some things you might want to look at. Peer-to-peer lending, of course, got a whole topic of discussion for the different companies, some of the news that I have this week, some of the updates. And one thing I'm going to try to do this week is to say less. I've noticed that I say a lot, and it's hard to do. You know, when I'm talking to a camera, I always find myself that I want to use these filler words, and I don't consider myself the best public speaker. I'm definitely not the most articulate, and certainly not the most knowledgeable in all types of finance and conversations and topics, but I'm really trying to pay attention to become a better speaker and to say yes and yes. So please excuse me if I do that. Feel free to call me out on that. So welcome to everybody in the chat stream. I see hi Peter and hi Smith. I think your name is Paul, David, and Martin, always in Leeds. Derek. Yes, I decided to move the stream up a little bit in time. It usually is at 7:30 p.m. I'm still over here in the US. As you can see, it's nice and bright outside. But I thought doing the stream at 8:15 would give you a chance to give your appreciation to the NHS and not have to worry about being on the stream and then hopping off. So that was my thoughts on doing it 8:15. I hope that works for you. So let me know where you are in the UK or in Europe or in the US. I'd like to always know where you're situated at. Currently here in Orlando, I see we have Leeds and some of the other places that I know you're listening in from. So, and please take a second, just hit that thumbs up button if you can. That helps with the YouTube algorithm and the searches for my YouTube channel, which has been growing little by little. Definitely not a power YouTube user, but I am trying to increase the channels. I would like to bring you more content and to put up videos every week when it comes to peer-to-peer lending and investing. So let's see, Annabelle, you're in sunny Dorset. That's my neck of the woods. Yeah, I'm usually based down in Poole. So I see you're in sunny Dorset. And yeah, Hillary, no problem. Welcome. Happy to start later. Derek, you're in Devon. So yes, I try to make this stream as interactive as possible, and please just put anything in the comments that you'd like to be discussed. If you have any questions or comments about your investing, you know, we're in this strange time right now where we're seeing this volatility and just uncertainty. And yeah, I'm in the same boat as you. I wonder about my investments. Are they in the right places right now? So I'm always interested to know, where are your investments right now? Are you concerned about anything? Have you exited out of the stock market? Are you sitting in cash? Do you feel comfortable with your investments the way they are? So if you have any comments on that, please put it in the chat and I'll sort of discuss that and what my thoughts and feelings are. And if you have any questions about any peer-to-peer companies in particular that you're concerned about, or where you have money that you're considering exiting or entering, happy to give my opinions. Again, the stream is opinion-based. Everything is just purely my opinion. And I've been studying the market for close to 5 years. I've been investing in peer-to-peer. And I do have contact with a lot of the peer-to-peer companies on the backside. So not on the bottom backside, but you understand what I'm saying. So I try to get as much information as I can. Some of the peer-to-peer companies are being very tight-lipped at the moment about what they're doing. I think some of them just are not really sure what the environment is going to bring in the future, so they don't want to put out any information that's going to sort of scare any correct. So some of them are being a little bit tight-lipped about the information they're provided. So And by the way, I put a shirt on today. I was getting a little bit sort of cabin feverish with not being able to dress up, and so I put a little shirt on today, a little bit different from the t-shirt. I almost went with the suit jacket, but probably next week. So I'll just go through your comments and see. Mr. Smith, Assets Capital not letting me withdraw from my holding account. Not sure why. I have been able to take money out, I believe, but small amounts. Hi from Overton. Alan, I must admit, I have no idea where Overton is, but yeah. Ian in Hull, special place in my heart, right across the bridge from Grimsby where I grew up. So hi, Ian, Taylor. AC chat, the quality seems much better in the office than your living room. Yeah, maybe the webcam is better quality. So you can see my vinyl record collection back there too. So it's a bit messy. I'll have that sorted. Let's see here. Peter says, I'm sitting tight on everything. Selling when everything is low is a classic no-no. Yeah, market timing is a very difficult thing to get right. And I did a little experiment over the last, I would say, 10 days. I took and this is something I would never advise anybody to do. I took a little bit of money and I put it in a trading account because just to see if I could market time my way in and out of a couple of different stocks to see what would happen. And I can report that my original findings about trying to time the market being impossible are exactly right. I think the trading account is down 50% today when I looked. It wasn't a huge amount of money. I put a bit of money over in the US here, about $400 US, just as a test because it's not something I would ever put a lot of money into for trading purposes. But I was trading this stock called the USO, which is the United States Oil Fund, which is a stock that's very, very volatile. And, if you'll learn anything from a stock trader, they look for volatility because that's how they make money. They make the gains when it goes up a lot and the losses when it goes down. Trying to time that is very difficult. So the United States Oil Fund has been disastrous because of, look what's happened to oil. I was definitely on the wrong side of the trades when it came to my experimentation. I did look at the USO Oil Fund ETF back when it was $11 to $12 and thought, well, it was about $5. I'd seen it fluctuate from $4 to $5. I thought, you know what, there's some room there to trade that stock for fun as my little experimentation. And the fund proceeded, I think, to go down to about $2.50. So great lesson on market timing, how it's just extremely difficult to get right. So yes, timing is difficult. So just go through your comments here. Richard, I've tried to stick with peer-to-peer rate setter and finding circle in stock market, but increasingly think cash might be better for a while. Yeah, I mean, the problem with cash is this. Let's say you liquidated your stock portfolio. The problem is it's such an emotional investment game that when would you feel comfortable going back in? What was the Dow Jones was down to 18,000, down from 29,000. That's a significant drop. And still people were wondering at 18,000, well, is this the bottom? They still just didn't know when to get back in. And my neighbor actually told me that he liquidated his entire retirement account into cash, I think a year and a half ago, and he was sitting and waiting and watching the markets just rise and rise. And emotionally, he was really struggling with it because he thought, well, is this market ever going to drop? How do I know when that timing to get back in is? And that's the problem with going into cash. You'll never emotionally know when that right time to enter and exit is. And I've been experiencing that myself with some cash that I've had sitting in a brokerage account, wondering when is the right time. Personally, I think the stock market is acting very strangely right now. I would not at all be surprised if we didn't see another 20 to 30% drop given the economic news and what's going on. I don't think the markets where they are represent a true picture of where the economies are in the world. So sitting in cash seems like a smart idea, right? But again, when do you get back in? you could sit out for another year until after the U.S. elections and then try to have a go then. But again, if the elections do what happened 4 years ago when Donald Trump came into power, the stock markets took off when everybody was guessing, well, if Trump gets elected, we think the stock market is just going to plunge, and they didn't. So it's just very, very difficult to know. But look, cash is always a problem long term because of inflation, how that eats up your cash. It could be probably one of the worst investments long term. Short term, yes, it's a safety net. So if you can figure out when to get back in. Okay, Alan, yes, I'll definitely address Growth Street. Annabelle said, yes, very smart. I've done my hair. I did do my hair and trying to keep it manageable. Again, please hit that thumbs up button. We're going to talk about a lot today. We'll definitely talk about Growth Street, Rate Setter, Funding Circle, what else? Crowd to Fund, LoanPad, Lending Works, and a little bit of Lendy. So got all that to cover. Dale, yes, I'll be talking about assets, capital. So yes, let's go ahead and start going through where we are right now. There was an interesting research report from Moody's about peer-to-peer lending over the last week, and the analyst said, well, peer-to-peer lenders are really going to feel possibly the crunch of what's going on because unsecured lending is going to be the first thing that people default on. So companies like RateSetter, which are very high percentage of unsecured lending, they do some property lending, but personal consumer credit may be the ones that really feel the crunch on the loan side, especially if this virus continues, on and on for the next 3 months. People are losing their jobs. A lot of people that are losing their jobs are sort of in those lower income service industry areas. They're not necessarily the higher income people. I know there is some higher income people that have been made temporarily redundant, but for the most part, you're going to see people in those lower income areas that do take out personal consumer loans, and that could really affect loans through RateSetter and companies like that. But it's just really too early to tell so far what's going on with that. I mean, I would say give it another 3 or 4 weeks, we might have a good idea of how difficult the default situations are for companies like RateSetter and that. So there's also going to be a really fine balance for these peer-to-peer companies. What's going to happen is they're going to have to decide what their origination plan is, because a lot of peer-to-peer companies make money off loan origination fees. And if they're not writing any new loans and this continues, one wonders, well, do you keep your lending standards and credit criteria very tight and originate less loans, which means less revenue for the peer-to-peer lending companies? Or do you keep your origination standards very, very high and, obviously you're not lending as much, but you're keeping your loan quality high and hopefully your default's less? That really depends on what the peer-to-peer companies need financially to continue to operate. So I'm hoping that the standards will remain high, but that is one of the things that the Moody's report did speculate on, that the credit criteria starts to become relaxed through the peer-to-peer lending companies, and then the default rates start to increase. So we're going to keep an eye on that. As far as assets capital goes, I have been in communication with the representative over there, and they are working on a communications piece that they said would be released hopefully in the next 7 to 10 days. What that's going to explain is how the 0.9% management fee will be taken, and they haven't given me any information about that. And then also the communication piece will also cover how they're protecting the lending side of the loans and what they're doing to keep an eye on that. I don't know how in-depth that communications piece is going to be, but it's about the most information that Assets has given me personally over the last week or so. They haven't mentioned anything about any potential issues or problems that they think are happening, and I'm not sure that they really would, because they know I'm a blogger, and if they send me some information that's negative, likely I'm going to write about it. So they probably have to be a bit careful when it comes to that. So We'll talk about Growth Street. Yes, if you're a Growth Street investor, you would have gotten an email last Friday about, I think it was last Friday in the morning, about another loan going to the provision loss fund of £595,000. I used to be very, very bullish on Growth Street, and I've become less so, unfortunately, because of the three major loan facilities that have totaled, I think, £2.5 million that have gone to the loss provision fund. Two of the loans were covered by Growth Street themselves, but the £595,000 credit facility, I believe, will not be. But having said that, there is liquidity and cash inside of the provision loss fund. Last time I checked, it was, take a look, 1.19 million they had in that provision fund. So that 595 would go into that fund, so it'd be taken out of the fund to pay investors their interest. And then what they would do is try to recover that £595,000 loan facility outside of the fund. Now, the issue with Growth Street is they've just not been very successful with default recovery. They've only managed to recover £318,000 out of 2.5 million that's gone into the red. So that doesn't give a lot of positive hope towards default recovery. So that's one of the things that I'm definitely keeping a watchful eye on. And it is unfortunate because I think Growth Street has a great business idea that seems to work. And, the problem is if you loan to the wrong companies and the credit lines end up defaulting, it's like any type of lending. You have to be very proficient in your underwriting. And it seems like they've had a couple of real missteps when it comes to the companies that they're giving credit lines to. So that definitely would be something that I would be concerned about. So, yeah, Growth Street, I would not, I'm not particularly bullish on it at the moment. And I did withdraw money from them quite I'd say 3 or 4 months ago. Particularly when Greg Carter, the CEO, was replaced. That was when I started to have some uncomfortable feelings about Growth Street. And I don't know anything insider. I'm not saying that Growth Street is going under or they are necessarily having any real financial troubles, but I was very close to Greg Carter. And when he left, then I just didn't feel really great about what was going on with them. So let's just go ahead again. If you have any questions, just pop them in the chat. I will answer them. So we have Alan is near Basingstoke. Okay. See, Funding Circle put on a brave face and sent out positive emails, and we hear that they have been involved with the new government bailout scheme, but returns have dried up. Yeah, so let's talk about Funding Circle. If you're an investor, you'll have had an email saying that they are now an approved CBILS lender, which is the government basically is giving loans to businesses, and Funding Circle has been approved as one of the lenders. Now, what this has done, unfortunately, is current investors cannot invest in CBILS loans, nor can institutions. So you're going to see, at least in the short terms, that your returns are probably going to start decreasing. That's twofold. Number one, if the loans that you're invested through, these business loans, start to default, and I'm sure that increased levels of default will happen through Funding Circle. It's just the nature of the economic times. But you're going to see your returns probably dry up, or at least go into the negative on that side. And then as Funding Circle is getting all of these thousands and thousands of applications for the CBILS loans, which is, by the way, stands for Coronavirus Business Interruption Loans, which is a government-backed scheme that Funding Circle can take applications for. You're going to see, because you as an investor cannot invest through any of those CBILS scheme loans, that you won't get any returns from those loans. So what Funding Circle has done is completely stop their focus on any other type of business lending than CBILS. So as an investor, you're going to see the brunt and negative side of that. What else? So I think as of December 2019, Funding Circle had about 165.5 million in cash. Now, with this new CBILS loans that they're going to be able to take, you're going to revenue really start to increase. So that's a good thing for them as a business, because if they're just relying on their regular business lending, they may have sort of been burning through cash a lot quicker than being able to offer these CBILS loans, which is going to create lots of new revenue for them. That is going to be a short-term thing, I would hope, for investors' sake, that they will start to eventually offer regular business lending too, which will go towards your returns as an investor. So let's see here. Yes, you cannot invest new funds through Funding Circle at the moment because they are not going to be able to loan them out to anybody. So it would be a sensible move for them not to accept any new funds until they start taking regular business loan applications again. So that's what I can tell you about that. Do I think they're dire? No, I don't. I don't think that the government would approve them as CBILS lending company if they were in a dire situation, because that just wouldn't make any sense. Yes, Dale, I just mentioned about assets, how I have been in touch with them, and they will be sending out communications about their current situation and the annual management fee that's going to be implemented on May 1st. So you should receive something in your inbox and your email in the next, hopefully next week, but no more than 10 days, I would imagine. Philip says, I'm trying to offset low interest rates by putting lump sums in fixed rates for 12 months max. Imagine when you're saying lump sums, you're talking about savings accounts. So if it's not, Philip, tell me what it is you're putting the lump sums into. Cash available if situation improves and more confident in peer-to-peer. Yeah, I think that's it's not a bad strategy. David says, have you had any feedback from any peer-to-peer lenders as to how they're financially coping during the coronavirus lockdown? Do you expect failures, and who is the most likely? Yeah, David, so I'm not going to start calling out companies, because that would not be a fair thing to do. And again, it would just be my opinion. And I would say if this was a very long-term situation we're talking about for the next year, the likelihood of failure would be higher. But what I do expect companies to do is to start pivoting, kind of like Funding Circle did. They found a way to be able to tap into the CBILS government scheme as a way to bring in new business. And I would imagine other peer-to-peer lending companies will apply to be a part of that. So you might see new opportunities in the peer-to-peer lending space. Unfortunately, for investors on our side, that's bad, because we cannot invest in those loans. But what it does is it keeps the peer-to-peer companies afloat and a revenue generating, which is what we want. We don't want any of these peer-to-peer companies to go into administration because they can't originate new loans. That would be just a bad place for the companies to be in for us as investors. So, but yeah, I don't really have any comments on who I think is going to fail, because I think that would be wrong for me to start talking about those kind of things. But if I do hear anything, I mean, I'll obviously report to you when I hear some real facts about if any of them are going into administration, which I don't expect that today. So, hi Alfredo in London. Ken, hi. How is it in Ireland? I won't say top of the morning to you, because that would be so very stereotypically Irish that you'd probably hate me for that. So Ken says, can you say something on the large amount of quantitative easing, aka QE, being proposed by most Western governments, and this effect on peer-to-peer lending, particularly if this leads to marked currency inflation? That's a highly technical question, Ken. My thoughts are that quantitative easing has been a real shit show, excuse my language, ever since 2008, because it's really just masking a bigger problem, which is the massive amounts of debt that countries are now were in before and are now going to be in even deeper. And the debt just seems to be increasing. It's never attacked in most cases, especially in most Western countries like America and the UK. You just keep printing money, right? Keep printing the money, and what happens? How do we problem? I don't know what the answer to that question is, because the governments can't seem to figure it out. How that affects peer-to-peer lending, I'm really not sure. I don't necessarily know that it would. Money being pumped into an economy is good for businesses, but you've eventually got to pay the debt off, right? If you're a business, say some of these huge businesses are getting bailed out, they're going to have to pay that money back, and how they're going to do it, who knows? I don't know how they're going to do that, because the economy certainly is not going to be great for the next, minimum of 6 months. I mean, even if the virus passed in the next 30 days, how comfortable would you be getting on an airplane or a cruise ship? I certainly, I would love to be able to jump on a plane and go to London right now, but even in 30 days time, I just can't imagine being comfortable doing that. So it may take a while for those businesses to really be able to recover and then to repay that debt. So QE is good in one hand, that there's plenty of money being pumped into the economy, but on the other hand, the debt has to be paid back. So it's definitely an issue. Funding Circle, Agam, yes, you are right. They are part of the government loan scheme, which is good news for them as a company, but not for you as an investor, because you cannot invest in those loans. So Brian says, I was staggered to see Funding Circle appointed to CBILS. Their due diligence leaves a lot to be desired. Many loans fail as little as 2 repayments. Yeah, the real, my comment is, have the government ever really made any decisions that made complete sense? Governments are making boneheaded moves all the time. The problem for the government, I have a friend who works in a bank, right? They were one of the approved banks that were allowed to accept applications in the US for small business loans, which are small business emergency loans. That sounds great as a bank, right? The problem is, in their first 2 weeks, they had 17,000 applications. And one of the problems they had was there was just not enough people to process these applications, first of all. And there was not very much information about how these small business loans were supposed to work. How were they going to be funded by the government? How were the banks going to get the money from the government? And I think what the governments are trying to do is to approve companies like Funding Circle, because they need these applications to be processed. There's so many of them. They're probably thinking on a more basic level of what companies seem like they would be able to have a lending facility that could give out loans. Funding Circle does have a good amount of money to be able to offer financing to these businesses, but they're also looking at how can we get these loan applications processed, because there's so many thousands of them, and it takes time to do that. So you might see the due diligence being dropped because there are so many loans to go through. That's something that only Funding Circle really knows behind closed doors. So Dale says, luckily I exited from Funding Circle some time ago. Yeah. Is there something intrinsic about the CBILS scheme that means that retail? Yes. So I think it's a government rule that peer-to-peer lending investors cannot invest in those loans because they're government backed. So that's why. If any peer-to-peer does fail, do we as investors just sit back and wait? Would we get anything at all back? And if so, when? If they do fail, I think you're going to experience capital losses. We've seen it with Lendy. We've seen it with likely Funding Circle and Collateral. One of the problems with administrations is the fees are ridiculous. The administrators take on these massive fee schedules. They're allowed to bill whatever they want to a certain degree. And with Lendy, what happened was the investor stepped in and said, hey, hold on a second, how is this working for us? And we want to be represented legally. So yes, short answer to that question is I absolutely believe if a company goes into administration, you will see losses. Just as you would with a bond company, right? London Capital Finance, bonds, or the investors are going to see losses from that. Whenever a company goes bankrupt, you imagine if they are doing property loans, being able to recoup 100% of the property loans are very small because they're literally fire selling the properties to get rid of them quickly. And when you sell a property at auction under a fire sale, you're probably going to get a smaller amount of money back for the properties if they were valued correctly. So yes, you would see losses. If you're a investor through Lendy, please go check out the article on my website. If you Google Lendy, you'll see the article, and it says how to get involved with the Lendy Action Group Facebook group. You can join as part of the investor group that is representing Lendy investors that are, Lendy being an administration. I would highly recommend that. Also, Funding Secure has an action group. Again, go to my website, look at the Funding Secure review, and you will see the information how to join the Funding Secure action group. Encouraged to see construction getting back to work. Residential development may lag behind if people lose jobs and income. Yep, I agree. And Dale says, given what you said about Funding Circle, surely this will be a massive hit to their long-term investor confidence. Can't see how they could recover that from retail investors in the medium term. Yeah, think about Dale. Funding Circle is made up of a big portion of institutional money. So retail, while it used to be a much bigger percentage of their loan investors, now institution has taken that place. So I'm not sure that they necessarily care about retail investors and what they feel about Funding Circle, because they're just not getting as much money from retail investors anymore. And I think it will decline considering what's going on with the lending situation there and, not being able to exit. So the less retail investors they have, the less they probably are bothered about what is going on with the sentiment. So Mr. Grob, 65, says, my Zopa returns over the last year have reduced to less than 1% after vastly increased defaults. Yeah, it's unfortunate. I definitely never been a huge fan of Zopa. I think for what they offer, their return rates, the risk to reward is just not level at all. And you may see that change now that they are offering less risk. They're not taking on riskier applications from loan originations now. They're dropping the D and E bands of their loans. Now they're sticking to, if you're in the lower risk core product, you're only going to see A quality loans. And then if you're in the plus, you're going to see A, B, and C. So you may see those rates increase a little bit, but Zopa has, I think my estimated returns were supposed to be in the 6% range, and they dropped all the way down to 4%. I would expect probably somewhere in between 2 to 4 would be reasonable. If you've got less than 1%, you've been really unlucky with what's happened in your loan portfolio. But they estimate 4%, but I think it's going to be close to between 2 to 4%. Let's see. Dale says, by the way, thank you for doing this and all your work in the peer-to-peer investing space. Yeah, you're welcome, Dale. Not a problem. Glad to be of service. That's why I do this. Believe it or not, I've always done it from a place of giving, just to be able to give back and sort of share what I've learned. I don't really love being on camera in front of you, but I do it just because I think it's the easiest way to share current information. But I'm happy to do it, and as long as you keep supporting me and subscribing to my channel and visiting the website, I'll keep putting my ugly mug on camera here and giving you information. I'm happy to do it. Martin, you said we'd lose capital. Could we lose everything? Unlikely that you would lose everything. But there's always a chance that, I mean, let's say worst case scenario, right? You're a peer-to-peer lending company. You give out a bunch of dodgy loans that, you loan somebody $1 million and the property's worth $50K. The administration would take up all of that in fees probably, and you'd likely lose all your capital. But I don't think peer-to-peer lending companies are that, inefficient and inadequate with their due diligence. But I think there are some cases where some loans people will lose 100% of capital, but I would say that would be extremely rare. Chances are, I mean, I expect in my Lendy account that if I got back 30 to 50%, I'd be happy. So best case scenario, 50% loss. Worst case, probably 30%. So yes, it's possible. And by the way, this COVID situation, of course, it's so negative, but what it has done on a positive side is it gives you really a chance to reevaluate, your financial situation and what you're comfortable in and your risk levels. There's a lot of people that really live month to month. They don't have any savings. And what this hopefully has done for them is to give them a little bit of a scare to say, hey, these things in life can really happen. An economic meltdown that affects the world could happen. It has. And now we need to look at our finances and say, are we really prepared to receive no income for 6 months? I mean, speaking on a personal level, it's financial thing. Revenue really comes from people signing up for new accounts. I get paid as an affiliate and then through advertising. Well, for my business, what's happened is the peer-to-peer lending companies are shutting down temporarily. They're closing their doors to new investors. It means there's no affiliate revenue for the website. And then advertising, the peer-to-peer companies don't want to advertise because they're not taking on new investors. So, everybody's affected. I almost said infected. I hope everybody's not infected, but everybody is affected. And, it certainly made me look at my finances and go, wow, I'm so glad that I had a financial cushion in times of when income, is being reduced or eliminated. Because I think if this COVID situation hadn't have happened, then possibly something I wouldn't have necessarily looked at and thought, is it possible for a complete income dry up? Now, I've always succumbed to the idea that, you really got to have 3 to 6 months of your living expenses in an emergency fund. I'm a big subscriber to Dave Ramsey in the US. I think he has some great tips. I don't really like his investing advice, but he has this baby step program. And one of them is have 3 to 6 months of your living expenses in an emergency account that you don't touch. And I think a lot of people probably can't afford to do that. People that are living in paycheck to paycheck situations, but this COVID situation will make them look at that and go, wow, how can I better prepare for this next time? Maybe, having a second job in the background to save money, or having a business on the side, like an online business. So, there are some positive things that are going to come out of this. See, Dale says, I guess the positive about the roll out of the CBILS scheme for peer-to-peer investors is there is an increased chance that lenders will be able to refinance existing loans and therefore repay their peer-to-peer loans. Yeah, so hopefully what it'll do by these CBILS loans through Funding Circle will create some liquidity and will offer investors a way to exit. So that's going to be a real positive. So David says, in my experience, administrators are only concerned with raising sufficient funds to cover their inflated fees. I mean, the administration process of say Lendy has been extremely complicated, and these administrators like BDO and RSM, they are in business to make money, and they do have to cover their fees. They are highly experienced people. They do make certain amounts of hundreds of pounds an hour. So from the outside, from a negative standpoint, you could say, yes, it just seems like they're about themselves, and who knows? I don't know what the answer to that is. It certainly doesn't appear to be that they're working in the best interest of their investors, because maybe if they were, they'd be taking a performance fee schedule where they would say, all right, we're charging a flat fee of, say, £300,000, and then every loan that we recover will take a percentage of that. But they're not. They're billing hourly, and they've racked up about 1.7, 1.8 million in fees so far, which is coming out of the pockets essentially of investors. So it certainly looks like they don't have the interests of the investors up, unfortunately. Let's see. Is your dog quarantined? No, my dog is okay. She's not quarantined. Chica boy, you're welcome. Thank you. Not peer-to-peer, but do you have an opinion on the High Street Group's loan note program? High Street Group's loan note program. It's not football. I'd have to look at that. I don't know what that is. I'm having a guess that it might be a mini bond type of program. But yeah, I don't know. I don't know what High Street Group's loan note program is. I must have missed that. Sue, sorry I only managed to join. Do I have any developments with Grove Street? No, nothing more than what I've covered last week about them having another loan facility that defaulted and now has gone into the loan provision fund. But I've emailed for some more information. Haven't heard anything back from them yet. So I do not have any information, but I do not have the best feeling about what's going on with them. But they do have liquid cash in their loan provision fund. So they've got, let me see how much it is. They say they have 1.19 million. So that would cover, any of those defaulted recent loans. They're not accepting new borrows at the moment, but I would say over the next few weeks, you will see the liquidity start to increase. I think what they're most afraid of is everybody running for the exits at once, which obviously would be really bad for them, since they are pretty much all retail most of their investors are retail, I believe, if not all of them. So I imagine if everybody ran for the exits, that would essentially be very bad for their business. So I think they're putting the brakes on. You can't, if you're a Grove Street investor, you cannot change any of your investment settings at the moment, which means that your money is being relent. I think that if they allowed you to change your investment settings, that most people would put a pause on their investing and try to exit, which would ultimately be bad for the company. And in their terms and conditions, every single one of these peer-to-peer companies has terms and conditions that allows them to make provisions like that under abnormal market conditions that we're seeing right now. So do you have a favorite peer-to-peer internet forum? Yeah, the peer-to-peer independent forum is very good. It's about the only one that I have read and been a part of that I thought was worth reading. Chicka boy, please give this gentleman more likes. He's very kind. Chica Boy is saying, please give me a thumbs up if you can, because it helps me out with the YouTube algorithm. So unless you hate the stream, then obviously don't give me a thumbs up. Leave me a comment. Tell me what you'd like to know about, if there's anything. So Alan says, I'm currently putting money into Vanguard's U.S. equity index while the value is depressed for the long term. Yeah, so I think that obviously, if you're taking a very long-term look at the markets, the U.S. market will recover. Well, how long it's going to take, we're not sure. I mean, you've already seen a recovery from Dow of 18,000 up to 23. So Dow was at 29,000, went down to 18. It's a big drop. Now it's already recovered somewhat. Question is, does it downturn again? I think there's a high possibility of it downturning again. But I think as a long-term play, absolutely nothing wrong with buying low-cost index trackers. Particularly US ones, I think, are strong. I'm not a fan of the FTSE 100 trackers or even a European tracker. They just have not performed very well long term. So I've always been a fan of the US broad market tracker that tracks the S&P 500, the NASDAQ, and the Dow. And also, you'll see that companies like Fidelity they also have a similar product, but they don't invest through the same benchmark. They invest through a different S&P 500 benchmark, so they have less equities within the fund. Vanguard has about 3,500 in the fund, different stocks, and Fidelity's version has about 505. But the differences in the performance because you've been in a very much a bull market for the last say 5 or 6 years, and when it's concentrated, Fidelity's fund is only 505 stocks. You're going to see a better performance during a bull market, but during a bear market, during a downturn, you'll probably see Fidelity's index tracker perform worse than the Vanguard one because it's more concentrated into 505 companies versus 3,500. Dale, could you give us a quick primer on the background to the Lendy collapse? Do you know why the administration has been so complex? Based on what you know, which companies have the better provision fund ratios or payout terms? Yeah, I'll go ahead and chat about Lendy at the end, Dale. I can give you a quick without boring, but I do have an article on my website that really sort of shows what happened to Lendy. Let me go ahead and I'll put a link in so you guys, if you want to read it. Basically, like I said, I'll give a quick primer at the end, quick rundown, so that you can read the article. So one thing also too, if you have FSCS bank accounts, really make sure that you don't have more than 85,000 in one bank, or if you're in a joint account, 170, so 170,000. You also have to be careful that some licenses are duplicated. Like there's certain banks that are under the same banking license. So if you had 85 in one bank that was under one license and 85 in another bank that was under the same license as the first bank, your other 85K wouldn't be covered. So you want to go on the FSCS's website and just make sure that you only have 85,000 or 170 in a joint account in one bank under one license. And also, if you have cash in a brokerage account, make sure that you don't have more than 85,000 sat in a brokerage account, because if something happened to that brokerage, highly unlikely that somebody like Fidelity or Charles Stanley were to go out of business. But if it did happen and you had 200,000 pounds in cash sat in your holding account, same goes for peer-to-peer. You don't want to have more than 85,000 in any of these holding accounts that are FSCS protected. So that's something to definitely check if you are blessed to have a bunch of cash just set around. So let's see here. What else? So Crowd to Fund, I saw in the news, has paused new loan listings and has frozen their secondary market. If anybody here is investing through Crowd to Fund, put it in the comments, as it's not a platform that really comes across my desk very much in emails. People don't really ask about it, so I don't have much knowledge about Crowd to Fund. So if you're an investor through Crowd to Fund, I'd be interested to see if anybody here is actually investing through them. And Orca, they were a peer-to-peer loan aggregating company that connected two different peer-to-peer companies under one dashboard. They are also going to be winding up their business, which was a shame. Ian, who ran Orca, I think he was a good guy and he had a lot of good ideas, but I just figured they just couldn't make enough money out of what they were doing. They're taking a management fee off of the amount of funds that were going through their company into these different peer-to-peer lending companies, but it just wasn't financially sustainable. LoanPad seems to be operating as per normal. They still have a very low loan to value of just 28%, which I think is the lower the loan to value in this economic time, the better. I've been able to withdraw money out of LoanPad still no problem. And they have one default so far, which is £366,000, and that money interest is being serviced by their provision fund, which is not a very big provision fund, but they have enough money in there to service the interest on that loan. So it's not suspended. It's just currently being handled. So LoanPad seems to be still operating well. Let's see. There was an interesting news story that I read about RateSetter put out a report about their Q1 returns being stable. The average of their Q1 loans, they said were, I think it was 1%, had been in the positive for them. Q1 gold was up 12%, Bitcoin 4.3%, government bonds 3.9%, savings, you would have gotten a 0.03% return. If you had a FTSE 100 tracker during the first quarter of 2020, you'd be in the negative 25%, and corporate bonds, you'd have been in the negative 0.07%. So you can kind of see how volatile some of these investments were. Gold is, I don't think gold has ever been a very stable investment. It's all about market timing with gold. If you got in January 1980, you would have paid $2,000 or $2,200 and something dollars for an ounce of gold. But if you'd have invested 5 years later, you'd have paid $440 for an ounce. So if you got in at 440, yes, you would have done very well. But if you'd have gone in at 1800 back in the 80s, you would have found gold to be just a terrible investment. So the gold's definitely not a stable place to put a lot of money, but who knows, if there was a complete world meltdown, it wouldn't be bad to have some gold just as a trading currency. But it's definitely not the be all and end all safety that a lot of people have written about. I'm going to talk about mini bonds too in a minute, and some of the issues that's happening with those. For anybody that's invested in mini bonds, highly cautious. Please be highly cautious of mini bonds. So LendingWorks has stopped new signups. Still, they've paused everything. So nothing has really changed with them. If you log into your LendingWorks account, you can withdraw money from your holding account, no problem. I've done that, but you can't invest anything new. So they're in a wait and see pattern, same as Octopus Choice. So that's about what I have for peer-to-peer lending news. And let's talk about mini bonds. There was another mini bond provider that has gone into administration this week. It's a small company called Blackmore. About £45 million in mini bond offerings, which, probably not that small. I mean, London Capital and Finance was in the £235 million range, so considered large. Blackmore, £45 million now in administration. So I've always been just completely negative on mini bonds, and some of the peer-to-peer companies offering mini bonds. A lot of people don't understand what they're investing in. When it comes to mini bonds, essentially, in most cases, you're giving company A, who's issuing the mini bonds, your money, and then they are then investing that money on your behalf. So if the company goes into administration, chances of you getting that money back, who knows? Probably very low. So I just don't believe in investing in companies that pooling money together to try to do things like property development, because if that property, something goes wrong with it, there's no security for you as a mini bond holder in some cases. Now, this is not in every case, because some mini bonds are written differently than others, but in the most part, the way that the mini bonds are written is we'll say the property secures the bond, right? So if something goes wrong with the property development, that property would essentially be recovered and sold to put money back into the bond. Problem is that if the company that's offering the mini bonds doesn't do what they say they're going to do, and they go into administration, you are going to be at risk of losing, could be all of your capital. And mini bonds are just not a place that I think I would personally invest. There's companies like Wellesley that offers them. I just wouldn't touch them myself. Personally, I don't feel comfortable just loaning my money to Wellesley to do whatever they please with it. So be careful with mini bonds. We've had Bassett and Gold have gone into administration, and Blackmore within the last couple of weeks. I just don't love them. So careful on the mini bonds. There's tons of them out there too. I mean, you see ads pop up on my computer for mini bonds all the time. We're going to pay you 7%. We'll pay you a 7% return annually for a mini bond. And it looks great, right? I mean, on paper, great. Let's get a 7% return, but at what risk, And the FCA has banned advertising of mini bonds now. So the FCA obviously has no faith in mini bonds and doesn't have any faith that investors know what they're getting themselves into. So they do not allow mini bond ads, which says, hey, mini bonds are very high risk. And whatever you're getting for your return is not at all in line with the risk you're taking on a mini bond. I mean, to get 5 or 6% on a mini bond is insane. I mean, that level of risk probably is equivalent to you should be being paid 12 to 15%. So it's just not a good spread. Anyway, that's about all I have. We're coming up on 57 minutes. Again, please hit that thumbs up if you have any other questions. Pop them in the chat. We've covered a lot today. I still haven't got any better handle on me saying I've noticed. So that's a work in progress with the personal speaking. But yeah, we've covered a lot today. If there's any new news, again, I'll be on the stream again next week. Hopefully this 8:15 time works better for you than the 7:30 time, because you can go bang your pots and pans, say thank you to the NHS, which I think is a great thing too. If anybody works for the NHS, thank you for your service. For any medical people out there, you are putting your lives on the line, and I certainly appreciate what you do. So yeah, that's pretty much it. I'm going to wrap the screen up, and thank you for joining me. Please visit financialthing.com, and I will see you next week. Take care, and please be healthy and safe.